Welcome back. This is Lab 4, Lab 7.4, and it's question number 3 of 3. Here we are going to prepare some more journal entries, and we have some T accounts provided for our calculations, but they will not be marked. A number of transactions are described, and we need to make adjusting entries for 2014, 2015, and 2016 year-end adjusting entries to estimate the uncollectible accounts. So at year-end December 31st, 2014, reading at the top up here, we had unadjusted balances of $250,000 in accounts receivable and $5,000 credit in the allowance for doubtful accounts. So that's the normal position, and $1,225,000 in sales, but that doesn't, they don't give a T account for sales. Uncollectible accounts are estimated to be 4% of the outstanding accounts receivable. So on December the 31st, 2014, we need to set up bad debt expense and allowance. And the target that we need here is 4% of the outstanding accounts receivable, which is 0.04 times 250,000 or 10,000. We already have 5, so we just need to make the entry for the difference of 5. So 5,000 here and 5,000 there. Then December 31st, 2015, the general ledger showed unadjusted balances of $260,000 in allowance for doubtful accounts, $260,000 in accounts receivable, and $2,700 credit, and we'll have to take that one out, and $1.2 million in sales. Uncollectible accounts are estimated to be 1.5% of sales. So that it doesn't matter what the balance is. So let's just go here. 31st of December, bad debt expense. And the bad debt expense is actually, it's an income statement approach, right? Because we're talking about taking a percentage of sales. Sales is on the income statement. So the one we're estimating is bad debt expense, 0.015 times total sales of 1.2 million. Then of zeros, 18,000. So it doesn't really matter what the balance is in the account receivable. We're going to put in 18,000, and so it's going to tell us that the ending balance is going to be 20,700. If we were using a balance sheet approach, which we were in 2014, the 27,700 would be the target amount. In this case, the target is the bad debt expense of 18,000. So we need to, okay, what are we using for the, it says enter an appropriate description for each journal entry. So we can write down to record bad debts, and we can use that same description for all 3. And the same date for all 3 as well. And the same accounts. Oops, there we go. Okay, then unadjusted balances at December 31st, 2016 were $200,000 in accounts receivable, 2,500 credit. Take that out, and take this out. Okay, $775,000 in sales. Southgate Inc. prepared an aging analysis on December 31st that estimated total uncollectible accounts to be 11,100. So that again, it's a balance sheet approach because we're looking at the allowance for doubtful accounts. The target needs to be 11,100. We have 2,500 in there already, so the amount of our entry will be the 11,100 minus the 2,500 we already have reported. So 8,600 is the amount of our adjustment there. Okay, lost it somewhere along the way. There we go. So in the first case, we estimated the uncollectible accounts to be 4% of outstanding accounts receivable. That gave us the target allowance. We adjusted in order to hit that target. The next one, we were using sales, so an income statement approach, 1.5% of sales. So we calculated bad debt expense directly, and so the amount of the calculation is shown here. And then finally, we used an aging analysis and identified the accounts receivable, the allowance for doubtful accounts related to the accounts receivable at that time as 11,100. That's also a balance sheet approach. So that tells us that the balance we're targeting in allowance for doubtful accounts is 11,100. We get that by adjusting the opening balance, or the remaining balance in allowance for doubtful accounts, for the correct amount. Let's see what Lyrics thought of that. Lyrics agrees. We're done.